Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So why use ETFs for sector rotation? Well, there's a couple of reasons. Traditional sector rotation going forward is going to change. We've got people retiring and taking money out of the stock market, something that we haven't had. And the baby boomers, including my age, my generation, will be taking money out of the stock market pretty rapidly going forward here. The financial crisis from 2008 has dramatically changed the world's financial situation. The debt crisis that we're having to try to respond to prop up our governments, both here and overseas, are going to change things. We have our government involved in the private sector in places that it's never been before, in the auto sector, in the insurance sector, in the housing sector, taking over many, many companies. So the cycles that we're going to have going forward are going to be shorter. They're going to be sharper, just like this recent correction we had, with more frequent mini bulls and mini bear markets. So investors, especially people that are going to be trading for themselves, investing for themselves, looking to do things for themselves, should probably look to, in addition to trading safe sectors, putting money into the utilities when there's times of fear, or putting their money into healthcare, have the opportunity now to take advantage of declining periods and going short using some of the new exchange-traded fund products that we have, the inverse funds. So exchange-traded funds are very well suited now for bull and bear markets. And I have a list over here on the side of some of the exchange-traded funds that have become very, very popular recently. During the 2008 bear market, we had the PSQ, the SH, and the DOG, which again is the Dow, the S&P, and the NASDAQ. They gained about 51.5% for the NASDAQ, about 37.5% for the S&P, and about 29.8% for the Dow, respectively. So if we want to take advantage of the bear market cycles, in addition to going long some of the safer sectors, such as precious metals, such as energy, such as utilities, because they pay dividends, you also have the possibility of actually going long short as your own portfolio manager. You put money into the inverse exchange-traded funds. You can also use some option strategies to try to hedge your long positions going forward. And active traders, if you're going to do this on a daily basis, you can even take advantage of the 2 times, 3 times leveraged exchange-traded funds, which are really better suited for day trades and don't really help your portfolio when holding them for long periods of time. And by the way, Dan Sugar did a great webinar. There's always great webinars on the ISE website from other people talking about using exchange-traded funds, the basics of exchange-traded funds. Dan's actually going to do a part 2 of his original presentation, and he'll be doing that in a couple of weeks in September. So if you get a chance, you want to listen to that because he'll be explaining a lot about the leveraged exchange-traded funds and the inverse exchange-traded funds during that presentation. So another thing that's happening, of course, everybody's aware of it, and everybody, depending on who you talk to, is a little either comfortable with it or very upset by it. But if you look at some of the growth rates of some of the countries overseas, Qatar at 16.3% gross domestic product, Paraguay 15.3%, Singapore 14.5%, India 10.4%, China 10.3%. These are the places in the world, folks, Latin America, Africa, Asia. These are the places in the world where the growth is happening. Therefore, our companies and our portfolio managers are all looking overseas and then going global and going international to try to find areas where there's growth. And the exchange-traded funds that we're used to tracking in our market had an impressive 21% rally from the lows of March 2009 to November of 2009. However, during that same period, Brazil rallied over 114%, and the emerging market index rallied over 64%. So sector rotation, exchange-traded funds, is probably going to be, going forward, moving into precious metals, commodities, emerging markets. And so you, as a portfolio manager for yourself, you're trying to train yourself how to do this, are going to have to actually start to put a few of these exchange-traded funds together so that you can have them as part of your sector rotation strategy going forward. So we're going to start off this presentation and just focus on the 9 sectors that make up the S&P 500 exchange-traded funds sectors. So I have those on the top here, which are the energy, the consumer discretionary, technology, consumer staples, the healthcare, basic materials, industrials, utilities, and financial services. So as a brand new sector rotator, as somebody who's trying to train themselves on how to do sector rotation, probably the easiest thing is to pick a basket of exchange-traded funds, and the local ones will be fine. And you can start to track them and chart them and keep up with the fundamental information that comes out on a regular basis before you start to actually add in emerging market sectors, foreign sectors, global sectors. Eventually you can branch out and you can start to replace some of the sectors that aren't really doing very well with other sectors that are doing very well. Okay. So the sectors that Dan talked about last week, and I borrowed this slide actually from his presentation, you'll notice that most of these sectors have average daily volume of over 4 million, 5 million, some of them as high as 64 million shares. But the average two range are very, very small on most of them. So for day traders, it's not really the greatest type of day trade opportunity, the individual exchange traded funds. These would probably be more for people that are interested in holding them for a few days and possibly holding them for a few weeks and months and using them as part of a longer term strategy. So not all of them are going to be good for day trading purposes. However, they all have options, which means you're going to have the opportunity, rather than buying shares, you have the opportunity to buy the call options if you're bullish and buy the put options if you're bearish. Okay, so these are the expanded list of sectors that State Street offers. You have your financials, your basic, you've got your bank ETF. So certain portfolio managers will try to break the financial sectors down specifically into the banks. You can also have the real estate international and local. You can have a REIT exchange traded fund, real estate investment trust exchange traded fund. We can add the gold in if you want so that you have some exposure to your precious metals. And then, of course, you have the rest of the exchange traded funds. So if you want to use a expanded list, possibly beyond the 9 basic, you want to add in gold, real estate, or some of the other sectors that will respond well during rising interest rates, if and when they ever come, then you can also add in international real estate exposure too. The International Securities Exchange has quite a few exchange-traded funds here that you could probably think about adding if you're going to add global exposure. There's a China Index Fund. Going forward, water may actually be something that is going to be considered a staple. People will always need to drink water, and the exchange-traded fund for water or the individual metals such as platinum and copper, which are more or less industrial metals, not quite precious metals. You can add those to your list of exchange-traded funds that you want to track. And there's also the natural gas exchange-traded fund, and eventually we will have a move to some kind of a greener energy policy. And natural gas, of course, is one of the things we have here in abundance that we could possibly use to offset our dependence on foreign oil going forward, too. So some of the tools that I use to actually check out the different exchange-traded funds, This is one from a website called XTF ETF Experts. And by the way, at the end of the presentation, all of the resources that I use for this particular presentation, I have them put together on a document where if you're interested in all the resources that I use to put together this information, you can send me an email and I'll show you a slide where you can send an email to me at Trading Academy, and I'll be happy to share this document with you for you to use going forward to help you actually begin going through the sector rotation process. What I like about this website is I can actually mouse over each one of the individual signs that you see here for financial, energy, consumer non-cyclicals, consumer cyclicals, and it'll tell me how many exchange-traded funds there are, and it'll also tell me the individual companies in the exchange-traded fund if I want to do some further investigation. Okay. And this website also has something that you can use where you can actually do a side-by-side comparison. So, for example, if you're interested in using the XLB, the materials, you can also compare that to the Vanguard offering, Dow Jones Basic Materials offering, the RIDEX, and you can just remove any of these, put in any of the other exchange trade funds that you want to put in there. You'll get rankings, and you'll also get some more facts about annual yield, average trade size, inception date, expense ratios. So as you begin to build your sector rotation portfolio, should you decide to go outside the exchange-traded fund offerings that the spiders have, you can actually compare these side by side. There's always the interest by most investors to diversify using a handful of stocks instead of exchange-traded funds. And I always get the question, should I actually go and build my own portfolio of individual stocks versus the exchange-traded fund? And there's a popular show segment on Jim Cramer's show called Am I Diversified? And he always says there's always a bull market somewhere, and that's a popular Wall Street saying. There is always a bull market somewhere. There is always money rotating into one sector or another. And the only problem you have with a bear market is, as most people probably know, all stocks are affected to some degree. All stocks will go down to some degree. So instead of looking for individual stocks and trying to pick individual winners, it may be best for you to begin charting global sectors, begin charting commodity exchange-traded funds, currency exchange-traded funds, and add them to your portfolio, because those are assets that actually do move inversely from the overall market. And you'll be able to obtain true portfolio diversification that way. But I have to tell you, Jim Cramer is exactly right. In a bull market, most stocks and most sectors do go up. It is pretty easy to pick winners during a bull market, but it becomes much, much more difficult when the market begins to turn from bull to bear. So in August this year, in a magazine called Traders Virtual Magazine, which is available on the Online Trading Academy website under the free resources section, I actually wrote an article which goes into full detail on market cycles in active trading. And I haven't written very many articles, folks. For most people that know me, my typing skills are rudimentary, to say the least. I tried to teach myself to type with more than 2 fingers, but unfortunately, it's getting harder and harder to do that. So I don't do a lot of articles. I haven't written a lot of articles, but I was kind of inspired to write this article based on a passing of Mark Haynes, and so I wrote the article, and you'll get a pretty good idea of market cycles, the way that I look at market cycles, and anybody that's ever heard me talk, of course. The economy has the 4-stage cycle: expansion, peak, contraction, and trough, and so I just want to chart my stocks pretty much the same way, with the same 4-stage cycle, which is accumulation, followed by the markup phase, the public participation phase, and then the distribution phase, which is usually where institutions like to unload to the public, and then, of course, the stage 4 declining phase, or the markdown phase. So the accumulation phase is usually after a recession is well underway and most people are scared to death and the news is bad, and institutions begin to accumulate large positions because they anticipate the market turning again, as it usually does 6 to 9 months ahead of the actual turn in the economy. In the case of this particular market cycle, with all the liquidity had pumped in by the Federal Reserve, a lot of these things have happened in light speed, folks, and some of these cycles going forward are going to happen at light speed. So to take advantage of the different types of trends that are available at this point in time, when we have the bull market trend, the primary trend, of course, is up. And during the bull market trend, that cycle can last sometimes 2 years, 5 years, can last as long as 2 to 5 years. The 2003 to 2007 market was an example of the last long bull market cycle. This one, of course, is only 2 years old, from 2009 to 2011. And you can usually see that play out on your high time frame charts, such as your weekly chart. That's the chart that I happen to use to chart that cycle. So that means if the primary trend is up, we can have what we call an intermediate term trend, which you can see on a daily chart, possibly on a smaller time frame, 4-hour charts, all the way down to 60-minute charts. And that can be either in the direction of the primary trend, it can be up, or it can be counter to the primary trend. You can have a move possibly of 5 to 10% down and still be considered to be in a bull market if it's a bull market phase. Of course, most people get very, very nervous when that happens, but those pullbacks are usually buying opportunities in the bull market, and it gives the investor that hasn't had a chance to jump on the bull market a opportunity to jump in with a little bit lower risk. And then there's the short-term trends, which are the intraday trends that most traders try to take advantage of based on news and economic data reports that are released different times of the day and all over the world. And you can try to take advantage of those trends if you want, as long as you keep in the back of your mind what the primary trend is, and are you trading with that trend or are you trading against that trend? So since the beginning of May, and May was the last time that I did a presentation here. I did a presentation for the International Securities Exchange. I believe it was on May 10th. And we have had a little bit of a bear market. We've actually had a market that has gone through a topping phase, and the market has broken out to the downside, so we began a bear market phase. Now, before everybody goes and says, well, how do you define a bear market and why do you say it's a bear market? Remember, when I give presentations like this, I always say to everybody that I have my rules to describe a bear market. And my rules for a market being in a bear market is if the market is trading on a weekly chart below a downsloping 30 weighted moving average, then it's considered to be in a bear market phase. Now, you may have different rules for how you describe a bear market. If you've gone through a presentation, if you've gone through a market cycle before, you need to have some kind of a rules that you can use to describe a bear market. Those are my rules for what I consider to be a bear market. And therefore, since the market has broken down below 30 weighted moving average, the weekly moving average, and it is beginning to slope down, then it's began a bear market. Okay? And until it actually rises above the 30 weighted moving average and that 30-week moving average begins to slope higher again, my rules say that the market's in a bear market. And I'm going to switch up to using my bear market rules for trading bear markets. Other markets, such as the commodity markets, anything that's priced in dollars, have also followed suit. And some markets that have done very well doing this, as safe haven plays, of course, are the bond market, the gold, and a few of the currencies such as the Swiss franc and the yen. So if the current market cycle is a bear market, then the primary trend is now down. The intermediate term trend, if it's up, should be used as shorting a rally into price resistance opportunities to join the primary trend. So my rules during a bull market are when market makes new highs or the market pulls back to some kind of rising support, such as that 30-week moving average, I buy the dips, okay? When the market is in a bear market phase and rallies up to a downsloping 30-week moving average, I short the rallies. And you'll see that there's opportunities to trade both with the primary trend and against the primary trend. And right now, in the last few days, the last 5 trading sessions, we've had 5 winners in a row, and the Dow actually managed to rally 5% off the lows. So this is one of those times where you've got a great opportunity to ride that intermediate term trend up until you reach some kind of resistance. And once you reach those areas of resistance, then it becomes a shorting opportunity. Now, in my world, I like to buy shares only if I can buy protective puts, protect my position. And I've done this for a while, and therefore I have my rules for how I do things, as I mentioned before. At this point in time, rather than buying shares, I would rather trade options to trade this intermediate term bounce that we're having right now. The reason being is I don't like to buy puts when volatility is as high as it is. And volatility is very high, so not a very good time to buy shares because buying insurance is going to cost me a lot of money. So I'd rather buy the call options in order to participate in the bounce that we're having right now. And when we reach the areas of price resistance, then I'll switch back up to buying the puts.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.